Welcome back. We're on chapter 2 of intermediate accounting, and we're going to jump right in looking at the accounting equation. So, hopefully, this looks super familiar to you from financial accounting, but if not, it's okay because we are going to do a review of this for the next few minutes, and that's what this chapter is all about, walking through that accounting process. So, remember, we have the accounting equation, which everything is based off of, which is assets equal liabilities plus equity. So you'll see this called owner's equity or shareholders equity, but this is the ownership in the company. So we know that assets are things of value. They are resources that the company has. And we are going to look at all different transactions and how it affects the assets and the other two elements of this equation. So the resources or the financially valuable things that the company has. And then liabilities and equity have to do with the claims to those resources. So, liabilities is where we have an obligation to an outside party for an asset that we have. So, maybe we still owe them for something that we have borrowed or that we have purchased from them. Or it even could be that we owe a customer a good or service for cash that they've given us. And the equity is the part that we actually have ownership in. So if you think about your house, you've got your house, let's say the value of that or the purchase price of that was $200,000. You still owe $100,000 on it. So the claim to that, the liability is $100,000 and then the equity is $100,000. Someone else has $100,000 of value in it and then you have $100,000. But total, the asset itself is $200,000. So that's the whole idea here with the accounting equation. So each and every transaction or economic activity event that happens to a company is going to have an effect on the accounting equation. And of course, it has to stay balanced. It has to stay equal. The assets have to equal the liabilities plus equity. So what we're going to do is we're going to look at a company, a fake company that I made up, and we're going to go through several transactions just as a reminder of how they affect the accounting equation. And of course, if you have recently taken financial accounting, this will be much more memorable than if you took it a few years ago. For me, when I went to intermediate accounting, I had not taken financial accounting for a few years, and I really struggled right in the beginning. So this review, if you're in that case, should hopefully really help out with that. So looking at the accounting equation before we jump into that mock company, one of the trickiest parts for people is typically the equity section. So we know that equity has to do with the ownership of the company. What do the owners actually have in the company? And that consists of two main elements. One is paid in capital. Paid in capital increases equity because that is where the owners have put money into the company, whether that is a million shareholders or if that is just one single investor, or maybe it's a private company that has 10, 20, or 30 investors. But that paid in capital doesn't have to do with operating income. It is just where people invested in your company hoping to make a return, as we talked about in chapter 1. Then we have possibly the trickiest part of the financial statements, which is retained earnings. Now, think about the word retained. It means you keep something, and earnings is profit. So, this is profit that you kept. So, this is where our net income gets rolled over and put onto the balance sheet into the equity section. So, retained earnings is made up of a few different elements. We have revenues and gains. So, revenues and gains increase that profit that we get to reinvest in the company. Then we have expenses and losses, which obviously are decreasing how much we get to put back into the company. But a lot of times, most of the time, hopefully all the time with your company, it's necessary expenses. It's not foolish expenses, right? And then the other thing that can decrease retained earnings is what? Do you remember? It's dividends. Dividends also decrease retained earnings because remember, dividends are where we are sharing some of our profit with the stakeholders, with the shareholders of the company. So we've got the revenue minus expenses plus any gains minus any losses. That's where we get our net income. But then if we decide to share some of that profit with investors, then that's called dividends, and that's going to decrease how much we get to reinvest in the company. So it decreases retained earnings. All right, are you ready to start going through some transactions throughout the rest of this video? We're going to see how the transactions affect the accounting equation. So our company we're going to be going through for these practice transactions is Young Counseling Services. So they're not offering a product, it's only a service in this case. So let's look at their first few transactions of their business. So first we're going to have that initial investment by the owner. So Misty Young invested $60,000 into her business, Young Counseling Services. So $60,000 would be increasing cash, and it would also be increasing equity. This is capital, paid in capital, put into the company by the owner, by Misty Young. So there's our paid in capital and cash. So what we would also call the paid in capital would be common stock. But we're going to get to that and reviewing all the journal entries later on, not yet in this video. All right, so they made their first transaction. Now we have a company. So then Misty says, I'm going to need to borrow some money. So she borrows $30,000 from Sixth Fourth Bank. So she borrows the $30,000. So if she's borrowing cash, that's going to increase assets. What's the other side of that when you're borrowing money? It's going to be on the liability side because we're going to owe someone. And so we've increased cash and we've also increased note payable. So remember, with a note, that is like an official loan. It's going to have signatures, it's going to be interest bearing. Unlike accounts payable, where it's a little more informal, usually it's just an invoice that was sent. So, and you're not usually going to have interest or anything with that. So, a notes payable, typically longer term, but doesn't have to be, but it is going to be more official. And when they're borrowing from a bank, that's going to be a note payable where it is going to be a more official situation. So, our equation still balances. We've added 30,000 to each side. Now, Young Company has purchased supplies from Blunder Paper Company of $2,000 on account. Okay, so they're getting supplies of $2,000. So that supplies is an asset to us. They're not using it up right away, so it's going to be an asset. We're going to have it sitting in a closet somewhere, sitting in some kind of storage box, whatever that is in that picture. Now, is this cash that they gave up for the supplies? It's not. And the reason we know that is because it says on account. You've got to look for keywords like that. On account simply tells us they have not paid for it yet, so it is a liability. So we've increased the asset of supplies and we've increased now a more informal agreement of accounts payable. So chances are they owe them in the next 30, 45, 60 days, something like that. All right, a few more transactions. So now they're going to perform services. Young counseled a client struggling with fear of demon teddy bears, earning $4,000 on account. Okay, so they earned $4,000. So if they earned it, that would be revenue. Revenue increases our retained earnings because that's money that we get to reinvest. Retained earnings falls under equity. So, okay, it's going to increase equity and we're getting something for it. We're getting a $4,000 asset. So it increases assets, increases equity, so we're balanced. But what asset did it increase? They did not give us cash for these services. Instead, at the end there, it says on account. So that's going to be our accounts receivable. So they don't owe us, or it's not due yet. They owe us, again, maybe in a couple weeks or a month or something like that, whatever the agreement was. It's unofficial. It's not a notes receivable because it's not going to have interest or anything, but they do owe us because it says on account. You could also look for something like with credit terms. That would be another thing you could look for. But it's going to increase revenue, which will ultimately increase retained earnings. All right. Now it's the end of the month and they say we're going to have to pay some salaries. Maybe they had somebody answering phones. Maybe they had somebody that was helping with some counseling. But when we pay the salaries, they're going to have to pay, well, here it's 2 counselors that they're paying $2,000 for the first month. And it looks like it's $2,000 total they're paying them. So it says they paid them. So we have assets leaving. And then we also have equity leaving because that money that we made in revenue, we're having to pay some of it out. So our assets looks like it's going to be cash. It doesn't say anything about they owe them next month or anything like that. So it looks like cash is leaving. And let me just remind you, cash doesn't necessarily mean they handed them dollar bills. It can be, they sent them a direct deposit from the bank, they gave them a check. All that's fine. If it's money coming in and out of the bank account, that counts as cash. And then the other side of it to make it balance is going to be our expense. So that would be salary expense. All right. So now they said, oh yeah, we had to have our lights on. We had to have the bathroom running. So we have utilities that we incurred over the month. So the utilities were $500 for the first month. They will remit payment next month. Okay, so they've incurred the expense this month. So we need to show it as an expense, but they're not going to pay it until next month. So we are going to increase our liabilities and accounts payable. The utilities company just sent them a bill. But we're also going to decrease our equity with an expense. So this one's a little different than the other ones we've looked at because there's nothing happening on the asset side. Both things are happening on the right-hand side of the equation. But we're adding to liabilities, subtracting from equity, so it evens out. Finally, we are going to make a payment on something that we owe. So Young paid Blunder Paper Company for the supplies purchased earlier in the month of $2,000. So, whoops, I left the accounts payable up there. So something's happening to accounts payable. Whether you knew it or not, we know together something's happening to accounts payable. So if they're paying them for it, we have some cash leaving, and it's also decreasing our accounts payable because we don't owe them for that anymore. So we're subtracting from both sides of the equation. Hopefully this is kind of jogging your memory of just how each economic event affects the accounting equation. Last thing I want to touch on in this video before you move on to the next video for chapter 2 is just different account relationships. So we have the double entry system, and that is just the fact, just like we saw, that there is a dual effect that each transaction has on that accounting equation. So the double entry system, we've got something happening to both sides of the equation, or perhaps two things happening to one side of the equation, but it's going to balance it out. So we always have to make that equal. Since kindergarten, we have to make things on either side of the equal sign the same. We make it balance, right? And we know that the balance sheet is based off of the accounting equation. We have to make it balance. The general ledger, that is all of the accounts that have any kind of balance. That is just a list of all those accounts and their balances. We see them a lot of times reflected similar to a T account. So it kind of has a similar look to that. But a T account overall is informally used, but it is to help visualize the process of where everything's going. So we're going to jump into that in the next video. But the T accounts, they're for instructional use, but also a lot of accountants use them in the real world. I use them when I'm like, okay, what happened here? What happened in this situation? I'll take a piece of paper, draw out a bunch of T accounts, and say, okay, so somebody debited this account and credited this one. Then this account was debited and this one was credited, and then it went here, so these canceled out. T accounts are super helpful, even in the real world, but they're also used for instructional purposes. But it's not like we hand out T accounts to the external users of the financial statements. Instead, They are just going to keep track of the balances and help us to visualize the whole process. And then ultimately, everything that's happened gets rolled into the general ledger so that we can see the balances in all of the active accounts. All right, more on T accounts in the next video.